Actually, would you mind if I played for you guys just this like 2-minute clip of Raoul Pal talking about how diversification is dead, just to get your feedback on that. You guys have 2
Sure.
minutes for that?
He must be in the diversification school of thought then.
What's diversification?
That's the argument against diversification, is that ultimately it makes your returns worse because it averages them down.
Which that's true, right? It just also means that it makes your drawdowns not as bad as well.
The idea is to reduce risk. Yeah. So if you're only thinking about returns, then yeah, your net returns are going to be lower, but your risk is also lower.
Yeah,
right, by design. That's the idea. But if you're saying I accept risk as a market participant, then yeah, diversification is terrible. Again, it all comes down to your risk profile.
Yeah, it's like comparing apples and oranges in some cases. It's like two different profiles of people with two different sets of goals.
Mm-hmm.
All right, so here's the clip.
In terms of asset allocation, because I remember years ago when you're more actively trading like macro specific trades, like of the world, from being one of being more cynical about a lot of these things to see. So I'm curious about like what that process has looked like. Do you still trade anything in that native macro world? Or are you just using that as a framework to apply to what you're doing in these other aspects, or what?
I don't trade anything in macro really anymore. My personal portfolio is pretty much, it's 100% crypto. Within Global Macro Investor and Real Vision Pro Macro, there are some technology bets and other bits and pieces around that, because it's all part of the same trade. What I found over this process was that everybody in macro had been struggling for about 10 years. The odd trade came along, like the buy bonds where diamonds trade. You can make a ton of money on it. But people were struggling because we didn't understand the world. Equities just kept going up. And we just couldn't get our teeth into anything because we weren't looking at the right thing. There was a mega trend going on, which was this liquidity cycle. And once you saw it, you realized that everything was correlated to it. So if everything is correlated to it, then it becomes interesting to say, okay, well then, if it's all the same trade, what's the best performing asset? Now, the other really important thing, what I think has happened, and it took me too long to realize this, I'm annoyed at myself, is that the Federal Reserve and all the central banks took away left tail risk. Left tail risk in a global macro view really is a debt deflation, which is when the value of your collateral falls too much that you can't pay for the debts and it gets called upon. And people sell the collateral and you get into this cycle. We had that in 2008. What did they do? Debase the currency. What did it do? Optically make asset prices rise, so the collateral went up. The Europeans did it even harder in 2012. So what they've said, and then we did it again in COVID. So what they've said is, you cannot have a debt deflation. We will not allow it. And we will debase the currency by 8% a year to pay for it. Think of that as a put option that you're paying on the system not blowing up, which is a very different way of looking at it, as opposed to, I can't believe they're robbing me of 8%. If you say, hey, listen, it's a mutualized cost of a put option, and we all pay 8% so the whole system doesn't blow up. Okay. So if we've taken away the left tail, and everything is correlated on this debt refi cycle, and they have to debase currency over time to do it, well, this may well be the best macro risk-taking opportunity of all time. Mm-hmm. And then when you just break it all down, what I did simply was divided all of the main assets by the global liquidity, or even the Fed balance sheet, whatever measure you want to use, M2 doesn't really matter. Nothing else goes up except the NASDAQ and crypto. Mm-hmm. And the NASDAQ since 2011 has done 17% a year returns, and Bitcoin's done 150. So you're like, holy shit. Okay, it kind of makes a mockery of anything else you invest in. Everything becomes suboptimal. So then people go, yeah, but what about the risk return, the volatility? That 150% return is after 3 80% drawdowns. They're included in that number.
The Sharpe ratio on Bitcoin is like ridiculous.
Oh, and the longer time horizon you take it, the more ridiculous it is. It's an alien asset class. We've never had anything like this. So I got to the realization too late that there is only one trade. And people hate it. People hate the fact that there's one trade and it's a new asset class. And they want it to return to the old days. They want to trade oil and they want to trade dollar yen and they want to trade. I'm like, it's all irrelevant. If our job as investors to maximize our profits or protect our wealth, Okay, wealth preservation may be marginally different, but if we're profit maximizers, then you owe it to yourself, because if not, every other trade is suboptimal, because there's no.
All right, so that's the idea there.
Yeah, so you really want input on his belief that crypto is the one trade right now,
or that liquidity is the only thing to actually pay attention to, because it's if you're dealing with an asset that is highly correlated with liquidity, because you're basically guaranteed that all central banks, all governments want the number to go up and to the right. And so you have the best support. You're on the best team.
But before I hear Mike's, because Mike's a lot smarter about this stuff, but what I heard, my kind of naive, ignorant, what I heard is that the banks and the governments are basically never going to let the market crash. And they're gonna swoop in and protect everybody before they let that happen.
Yeah, we're seeing that unfold in multiple occasions now since 2008. That regime has definitely changed, and that, I know, Tom, you and I have talked about that in former episodes, where the amount of liquidity that gets injected into markets to prevent massive crashes is always on the sidelines now. That's sort of a federal policy, which means that recovery should be fast and they should be swift, and we won't see as big of drawdowns potentially anymore, unless something else breaks down. Like, there's only so much you can do to manipulate markets before reality steps in, right?
That was another. We were talking about this in the last Friday, I think, about there's a similar question. We were just talking about this, I think.
It doesn't stop the crashes from occurring, or rather, it doesn't mean that
it was about the time in between the bottom and the
recovery times are faster.
Much faster. Yeah, that's what the other topic was.
Right. The recovery times are definitely faster. But that said, I guess Raoul's point after that was that global liquidity leads to really only two markets benefiting from these new scenarios, which is the stock market, he said NASDAQ specifically, and then crypto. And I don't know, for a long time, I've just kind of held that Bitcoin, crypto in general, is a speculative asset class that can be benefited from as long as there's still speculative participants in the market. But the inefficiencies we see in those markets are going to shore up year after year after year after year. He makes this claim that Bitcoin's enjoyed 150% returns over the last, I guess 15 years. But that's a summary stat, right? Like, when you take the whole period of time, which includes like 100 and something percent increase, or 100,000% increases in returns from early on, and you get the average of that, it's gonna sound like, oh, well, I can just bank on 150% of return. That's not the case anymore for crypto. Every year, those returns are diminishing, and the volatility is also diminishing. And I don't know how that returns if there's more market participants looking to enjoy the upside of it. The more people that jump in on it, the less volatile it's going to be. So
that's why I care about the I care just about the liquidity concept, because the crypto, to me, there's not enough history there, and I get that you might be swinging big and it might be worthwhile, but you can't put your wealth on that. But for when it comes to tech has the exposure to liquidity, because all the point he's making here, and that other people have made as well, is that even though nominally the stock market is going up, your purchasing power is not going up in the same way. And you need to purchase an asset that not only goes up and to the right, but that clears the hurdle rate of inflation, so that your purchasing power either stays the same or increases. And so for me, all these different tech companies, when I see NVIDIA, when I see Tesla, when I see Apple, who have network effects, they have a broad user base, they have exposure to, if anyone's going to get the lowest interest payments on their debt, it's going to be these larger companies because they're less risk. And then you go, okay, so then why ever invest in anything else? And then when I pair that with technical analysis, I go, well, then technical analysis tells me where the low points, probable low points for these things, and then for me the trades sort of like become obvious. I follow the mega cap tech stocks. When they hit their technical supports, buy there and sit back and relax. And so far, it's been working all the time. So I see no reason not to continue there. And when I see someone go like, oh, get into uranium or battery stocks or funeral homes or whatever. I go, nothing you're suggesting there is gonna matter at all. For me, like, I just don't see it at all how this liquidity cycle ever stops until the debasement goes to the point where the discrepancy between the top stocks, the top assets, the lower ones, are so high that it's just ridiculous. Never the end of it.
Yeah, well, so I mean, I guess from that perspective, it's a really good indicator to keep an eye on, because as it contracts, it helps us forecast what potential environments might look like in the future, and I think we can kind of tell what that means for the cost of capital for businesses in the United States, which of course translates to earnings within the broader indexes and kind of gives us a sense of where the stock market goes. But that global liquidity factor also tells us essentially the amount of purchasing power that the market has in order to keep supporting the price of cryptocurrency assets as well.
Actually, that's a good way of putting it. I gotta remember that. It's the purchasing power of the market.
It might not even be the right phrase, so don't quote me on that.
No, but I like that. I like that image.
An econ professor probably step in and be like, "You're not using that correctly, sir."
As long as we get more views than they do, that's all that matters. Don't worry about it.
But I think I like it as an indicator. Whether or not it's the only trade is really interesting. I think I've mentioned this book before. I really like Stocks for the Long Run, which ultimately is a fantastic book that's gone through 5 revisions now. And it's by Siegel, who's a Wharton professor on finance. And it covers all the different asset classes that have ever existed over the last 150 years or so, comparing their overall performance and expectations and returns, compounding annual growth rates, and like ultimately like tackling all these reasons why you would choose other assets, but then leading to this idea that the stock market is in general the better return, the better bang for your buck. But what doesn't really get pushed into that up until recently is how crypto performs as an asset. And it's really a tough one because as we look at crypto, it's just gone through all of these different narrative cycles that have changed our perspective about what it means as an asset class. And I think we're slowly entering a new phase now where like, okay, so utility doesn't matter anymore. People are willing to trade and hold cryptos that don't do anything. They're just meme coins. So utility doesn't matter. There's still no fundamentals. There's really no adoption in a way that makes it meaningful from its original intent, right? This was supposed to be global cash that we're supposed to use to buy things with, but I still don't see any. Are you using any Bitcoin to buy anything with, Tom? Last time.
Yeah, I use Bitcoin and Cardano. It's like,
so buy what? What are you buying? I'm curious.
When I'm making doing work for people abroad, instead of them having to PayPal or anything like that.
So you're using it for that.
Exactly, because I can't do, as a Canadian, like I can't do Venmo, I can't do certain types of transfers from bank to bank, or it's slow and all that sort of thing. I just do Bitcoin or Cardano, and I don't have to think about it anymore.
Okay, so I can't ignore like some of those transactions, but I think at scale though, we're not seeing, I think, the adoption we expected from crypto in the very beginning. So if we're entering a new phase of crypto as an asset class, the narrative around that is really just, I'm interested in this asset class for its inefficiencies and its volatility. And everybody's going to keep showing up if it's a speculative asset. But the less that occurs, I wonder how less interesting it becomes. If crypto stabilizes to a point where the rug pulls and the dexes are kind of gone, and the introduction of new pairs becomes less interesting to people, I'm curious how that changes over the next 5 to 10 years if it doesn't become an asset class with real utility behind it.
Does it seem as obvious to you as it does to me that there's going to be that crypto, it almost feels like how asynchronous JavaScript felt, where it exploded. Now we can do all kinds of things with JavaScript and send information asynchronously on the web. It allowed for the creation of all these new types of applications, and then that are so responsive. But the technology was there forever. Like it didn't just show up; it's been forever, and then they figured out how to use it for what we're using it now. And I feel like crypto is sort of like the meme coin frenzy. That's sort of like, okay, people are just it's the dynamic drive of the crypto space. But then clearly in the tech sector for the AI sector, there's going to be there seems to be this issue where we're going to be we need a way of, in a very granular way, tie my own data, like the data that I've been provided to AI. I need to be able to tie it in such a way that I could generate value from my data being used. So I write a book, and the book gets read by LLM, and it's then using that in order to give its responses. And it should be able to allocate 0.0001% of an answer to what I did, and then I should be able to get value from that. But I'm not going to be able to get that in. I need to be able to get that in an asset that's infinitely divisible, which is then crypto. So I'm just waiting for that merge to happen between crypto and AI, where the use case for the crypto is not as the currency necessarily, but as a way of attributing my data input for the AI sets. And it's only when AI started over the last 2 years that I was like, oh, that's where these two trains come in. That's what we're waiting for.
I've always thought of, in general, like blockchain and crypto as like developing an infrastructure and a platform that other stuff can be built on. And people always make the joke about crypto is looking for a problem for a solution. I think that's the quote. I think it's something like that. But I think you're right. I mean, I think as like this platform and like these rails mature, I mean, it could not happen, but I feel like people are going to build more and more applications and systems on top of this infrastructure. And we're waiting for the right moment.
I think the interesting thing is that is already happening. There are so many crypto startups out there that are really heavily investing in using blockchain to solve problems in new ways that we hadn't really thought of, new ways of forming organizations, new ways of creating multi-party incentives and profit share, equity incentive. If I start a startup and we're writing software, I might use blockchain in order to issue incentives and shares to my employees. Like there's things that are, I think, evolving in the space that could start to show up one day. And to your point, Tom, 10 years from now, we're like, okay, now, or 5 years from now, let's say, we're realizing the technology was there the entire time, but now people get it, and now they're using it for that purpose. If something like that happens and we really see it start to develop at scale, I think that would change my mind about crypto. But at the moment, and for several years now, it's just looked like it's a speculative asset class. It's the greater fool theory. Everybody just wants to make another buck on the other person.
It's so funny though. I think a lot of big technologies have been like that. I mean, the core of the internet existed for a long time before the internet was a thing.
Sure.
You could go even further. The computer,
the
first computer was mechanical, but it was a computer. And I'm sure people were like, oh, this is stupid. This is just a little toy. It'll never be anything. But then, hundreds of years later, here we are talking to each other on the computer.
But even as far as institutions are concerned, like you were mentioning, it's so funny. You talk to millennials or Gen Zs or whatever, or actually a lot of people, and to them, the stock market, it's like, well, it's always been around. And they have no concept for how businesses got capitalized before that. Like, the stock market provided a mechanism for businesses to be able to, one, get capital they wouldn't otherwise have, and two, a way of demonstrating transparency in a way they didn't need to do before. So then people had to, transparency became one of the something to, it's sort of like your company goes public, and now you have to change the way you're operating because you can then be audited by the public, and it created this new dynamic. And to me, I look at the crypto space and I go, the idea that that's not where all these assets are going to move to, all the assets we're normally used to, that's not where it's going to go. To me, it's like, well, it seems crazy. It's like, well, of course that's where we're gonna go to some system like that. And so that whole ecosystem, you end up in a situation where you're like, well, how do we pick a winner, right? Mike, you're just saying like, okay, it's meme stocks here. Like, how are you supposed to pick a winner? But the winner is any system that crypto depends on, right? The tech infrastructure that crypto depends on, regardless of whatever coins you're dealing with. That to me is what I want to invest in. But since I can invest in I don't know which of those platforms it matters, then I'm going to go to the and I see a collision with AI. Then I go, it's AI. Anything to do with the network effects with the tech companies that we're dealing with right now, any one of those that are actually focused on AI, those are the ones that I invest in. So the Meta, the Teslas, the what is it? Reddit just recently IPO'd, I think it was. Like anything that's dealing with AI and that has an eye towards crypto, that's what I'm doing. So I'm going to buy Tesla and I'm going to buy Doge. I'm going to buy Tron and I'm going to buy well, I can't buy Telegram, but anything that has the crypto and AI together, those to me are like home run stocks that we're going to look at. I could have bought Amazon at $9 in the 2003. Like that's what I'm expecting.
Yeah, I like it. I think what you're describing begins to form the next phase that we're entering into with crypto. Have you heard of the Gartner hype cycle and how that applies to technology? Maybe just do a search on it real quick and pull up the chart for it, or not chart, but like it's a graphic. Essentially, we're in what I would consider the trough of disillusionment for crypto at the moment. So when a new technology is introduced, you've got the trigger in the very beginning, and you've got this huge peak of expectations, inflated expectations, where people expect it to be something, and then ultimately it starts to fall off. I think crypto experienced that in 2017 when we had our first big push upward, and there was these big conversations about it being a new monetary asset. It was going to be the global currency. It was going to even be a hedge against inflation, and so on and so forth. And as a lot of these claims about crypto have kind of fallen apart and fell into the quicksand, we've entered this trough of disillusionment. So right now, I think the very things that will create the slope of enlightenment up into the next phase are occurring right now, but we just can't see them yet. And I think there are a lot of people that are likely bought in on this industry so much, their passion is so strong for it, that it'll feel like it came out of nowhere, but really they've been working on it the entire time. And when it gets to that stage, the final era of it is that plateau of productivity, where we finally get the use out of crypto that we were hoping for this whole time.
Raoul, in that video later on, actually I'll put it in the notes as well, talks about this idea that the robots, which we haven't talked about, right? The robots end up being a solution, could end up being a solution to the demographic problem, where we're not having enough children, and that if that does actually succeed, well, then we end up with, in a sense, infinite labor. And then if you have infinite labor and then the ability to capitalize it through crypto markets, well, then we're in a whole different problem where everything's free, or should be free if it was distributed equally, or we end up in the Elysium District 1 scenario where you have quadrillionaires and people with nothing on the ground. So
yeah, it's just a wider wealth gap at that point. Yeah, we'll see.
Right.